Hi everyone. Today I'm going to be focusing on stop losses, and what I believe is a bit of a misperception around stop losses is that if you put it so far away that you'll never get touched, is actually the best way to handle a stop loss. And for me, that's basically comes through a fear of taking a hit to your bottom line. And in actual fact, what we should be looking at is if stop losses are put in the right place for the right reasons, they can be very, very constructive to our trading. So how can I help walk you through that? Well, I'd like to talk about what I would call a risk-reward strategy. So get this concept in your head so that you can actually fully understand why stop losses are important to you and how they can actually help you plan a trade and over a series of trades end up in a much more positive frame of mind. So what I've got here is, just the simple concept of a trade. We've got a product here. It's priced at 130.50, and I decided I want to buy. And the first thing I should look at is where is my protection, i.e. where do I place my stop loss? And in this instance, I'm looking at all that historical data, my charts, and I see there's support lines at 129.80, 129.55, and 129.15. And for the purpose of this trade I'm putting on, I decide that 129.80 is the right level for me. And I therefore put my stop loss just below that support line, so I make sure it's not a false break. And so my stop loss is at 129.75. So I'm prepared to lose 75 ticks on this trade. So that is my risk. And then we come to the reward side of things. And unfortunately, as human beings, the minute our trades tend to get into a profit, we get very excitable and we want to bank that profit as quickly as we can. And it wouldn't surprise me, and I've certainly done it in the past before, that I get 25 points in call and I take my profit. Now, here's the rub. I've been prepared to lose 75 ticks on that trade, but I've jumped in and taken a 25-point profit. So in my eyes, I've got a negative skew to my risk reward, i.e. for every trade that goes wrong, I need to make at least 3, if not more, correct if I was to work off of this premise to even be flat on the day or over that series of 4 to 5 trades. And that's not always easy. So what I should be looking is to take a much, much higher profit, and minimum I would look at here is a 1-to-1 ratio. So I'd look to take profit up there at 131.25. Now I appreciate that it takes more patience, but if we actually strive to make this number and that type of ratio, we'll be a lot better off in our trading over the long run. Now I'll come back to that very, very shortly, but I also just want to walk you through why putting your stop loss so far away isn't actually very good for you. Because inevitably you'll come across this type of trade where you buy at 130.50. It's never in the money for you. And all it does is meander just below or between your entry level and your stop loss. And as you see here, I've put the stop loss even further to exaggerate that concept of moving your stop loss far enough away that it never gets hit. Well, in this instance, it hasn't been hit. But what you've done is wasted your capital. Your capital is not working for you. And that's what we really want to happen in the market. And you could have cut this out a lot quicker if you'd have had a better discipline around your stop losses. And you could have read and research and maybe got yourself into a more profitable trade in the interim. So a good example of why holding stop losses much further away don't normally work for you. Now, also want you to associate how far your stop loss away is with the type of trader you are and the duration you normally hold a trade for. If you're a short-term trader, very, very short-term, scalping the market intraday, I just want to leave you with a concept that if you're forever taking profit after 10 ticks, but then you find yourself 40 ticks out of court on another trade, then you're doing something wrong, because you should not be leaving that trade to run that far out of court if you're willing to take 10 ticks profit. It's very, very difficult, but it's something as an intraday trader, if you get that discipline right, then you'll be much, much better off over a series of trades. But as you see here, the longer you're prepared to run a trade, and with the volatility in the market giving you more opportunity over that longer period of time, you can afford to move your stop loss a little bit lower, because your take profit levels are much, much further away from inception, and therefore your risk reward ratios can be in your favor. Now, I do appreciate that, it's sometimes very, very hard to get that ratio in your favor. So how can I help you improve that risk reward ratio? Well, one of the ways is to stagger your entry orders. And why would we do this? Well, one of the biggest benefits is that as human beings, it's nigh on impossible for us to consistently find the bottoms or the tops of markets to get our entry levels at the prime spot. So by picking a level and then working around it and maybe staggering your entry orders a bit further away, you can actually maybe cheapen up your entry level. And in some respects, and I'll show you on the next slide, it can actually mean that if and as and when the market moves in your favor, you could actually have more leverage to your trade. And that's how you can increase that risk reward ratio. Now, one caveat from this, the disadvantage is that you may not always pick up every tranche of this plan. But my message to you there is that means the market is eventually working in your favor, and therefore you are going to take a profit. And that's always a positive place to be. So that's a quid pro quo that I would always accept works in my favor. So how do we stagger these levels and these orders? Well, I've got a simple S&P chart here, and we've got the range there of 3750, some nice previous lows there, so that informs us that that should be a nice strong support level. And up there, I've got a previous high at 39.21. So I've got my range that I want to work from. I can see the market up there, and my belief is that as it dips, I want to start buying because I think it's going to rally again. And my first level that I want to buy at is 38.35. So from our previous trading, we would have lumped all of our capital in at 38.35. So if I was to just look at this capital allocation bar here, if I had a simple calculation and I had £10,000 in my trading account and I was prepared to lose 5% of that on this trade, then I would only want to lose £500 and no more from this trade. Well, if I put all 5 units in, let's say at 38.35, and I've got a defined stop loss down there somewhere below 37.50, because we don't want to leave it right on that support, then I'm effectively, if I leave it at 37.35, going to lose 100 points if this goes wrong. And that's my £500. Now, the problem is with this is that my profit level has to be up somewhere towards 39.21. And if I were to leave it just for convenience at 39.15 for calculation, then I would only glean a profit of 400. So I'm still not got myself into this positive risk reward. So how do I get myself into a better place? Well, quite simply, I find my levels. I've got my charts to help me with that. I look to buy just ahead of those support levels. And then simply, I may buy 2 units at 38.35. I buy 3 units at 38.15. I buy another 2 units at 37.65. And if the market comes to me and I get all of these tranches, then basically I will have a much, much cheaper entry level. I'll have a combined entry level of 38.05. And here's the rub. I've now got 7 units in it rather than 5. So if the market bounces in my favor, I can glean a bigger reward. And as we see, if I was to take profit again at 39.15, then my profit will be £763. So basically, I've now got a risk reward in the positive of, for every pound I'm willing to risk, I'm going to glean £1.5 back. So that's that positive risk reward that I want. But again, I'm not cheating the system, because although I've got 7 units in it, if I was to get stop loss down there for the whole 7 units, because I've got cheaper entry, I would still only lose my £500. Now, just to play this out as the market moves and to see how we would play one of these trades, in this instance, I would have managed to got the first two tranches at 58.35 and 38.15. So I'd be sitting there with a combined entry level of 38.23. Well, that's cheaper than my original trading strategy at 38.35. I'm still in the market. It's moved back up in my favor to 38.43. So at market here, I'm still £150 in profit. If I was to play this out and I only got those 5 units, then I'd actually end up with a profit of £460. And again, I'm not cheating the system because I know 460 is not as much as 500 down that I'm prepared to risk. But again, here's the thing. The market hasn't gone down yet because I haven't received that final tranche at 37.65. So that whole risk reward scenario doesn't really come into play until I get that final tranche. And what happens is I've almost got a free bet, to be honest. It can go wrong over the long run, but all the while I've only got these 5 units. It means the market hasn't gone against me and I've still got that opportunity to glean £460. So hopefully that will help you structure your trades in a slightly better way, but please focus on this mentality of a positive risk reward, and that will stop you holding on to trades and being married to trades way too long when you should have been out of them a lot longer ago and maybe moved on to a more profitable trade. Thank you for your time. See you later.